The year is 1494. The most powerful banking family in the world is being dragged from their palace, while the city they own burns around them. Their vaults are looted. Their debtors, kings, popes, entire nations, simply stop paying. Overnight, 5 generations of calculated generosity, strategic loans, and engineered dependency collapse into ash and exile. Here is what history will never teach you in school. The Medici didn't just lose their money. They lost it because they forgot the single law that built it. And right now, today, the same dynasty playbook that built and destroyed the Medici is being run again by institutions you trust, on a balance sheet with your name on it. Number 1. Debt is the original chain. Rome, 63 BC. A senator named Julius Caesar is drowning in debt so catastrophic it would bankrupt a small city. He owes money to generals, merchants, and moneylenders across the republic. And yet he is smiling, because Caesar understands something that his creditors do not. A man who owes enough money doesn't become a slave to it. He becomes too dangerous to destroy. Here is what the history books never tell you about this moment. His creditors couldn't call on the debt without collapsing their own fortunes. So instead of controlling Caesar, the debt made him untouchable. He leveraged what he owed into political alliances, military command, and eventually, an empire. The chain they thought they put on him became the rope he used to climb. This pattern keeps repeating, and most people never notice. Because debt was never designed to be neutral. In ancient Rome, in Renaissance Florence, in every civilization that built itself on borrowed capital, debt was the mechanism of control dressed up as opportunity. The Medici knew it. The Vatican knew it. Every dynasty that ever ruled through finance understood that the moment you give a man a loan, you don't just own his future payments. You own his decisions. The same move is being made right now. Your mortgage, your student loan, your credit line, they were not sold to you as chains. They were sold to you as freedom. That is what makes this playbook so devastatingly effective. The prisoner helps build the cell. The Machiavellian verdict history proved is this: debt is not a financial instrument. It is a psychological one. And the people who designed the system you're living inside have always known the difference. What they built next made the chain invisible. And that is where this gets darker. Number 2. Proximity to power corrupts the ledger. Riss, 1715. The Sun King is dead. And before the body of Louis XIV is cold, the men who managed his finances are already rewriting the numbers. Not because the kingdom is broke, though it is, but because proximity to a dying power means one thing to every operator in the room. The ledger is now unguarded, and an unguarded ledger is an invitation. Here is what the history books never tell you about this moment. The financial architects closest to Louis hadn't just managed his wealth. They had quietly redirected it. For decades, the mechanism was simple and invisible. Contracts awarded to allies, interest rates adjusted for friends, royal debts conveniently misrecorded. Not theft, never theft, just the natural gravitational pull of power on numbers. And it worked because the king needed to believe the men beside him were loyal. The need made him blind. This pattern keeps repeating, and most people never notice. Because proximity to power has always corrupted the ledger, not through greed alone, but through something more calculated. When you control the accounting of someone more powerful than you don't steal from them. You architect your own enrichment into the structure of their empire. They have been using this playbook for centuries, inside royal courts, inside central banks, inside the boardrooms of institutions that manage your retirement funds right now. The same move is being made right now. The people closest to where your money is managed are not neutral custodians. They never were. Proximity is the oldest form of financial leverage ever invented. The Machiavellian verdict history proved is this: whoever controls the record of wealth controls the wealth itself. Louis never checked the ledger. He trusted the men who wrote it. And what those men built with that trust Is the architecture still standing around your money today? Number 3. Diversification was always political armor. Venice, 1400s. The most sophisticated financial minds in the known world are sitting inside the Palazzo Ducale, and they're not discussing trade. They're discussing survival. Because the Venetian merchant class has just watched 3 rival city-states collapse. Not from war, not from plague, but from concentration. Every egg in one basket. Every alliance with one crown. And when that crown fell, everything fell with it. What happened next was not an accident. Here is what the history books never tell you about this moment. When the great Venetian merchant families began spreading their capital across wool, spice, glass, shipping, and banking simultaneously, that was not financial wisdom. That was political engineering. Each industry bought them a different relationship with a different power. A stake in spice meant protection from Easter trade routes. A stake in glass meant leverage over the papal court. Diversification wasn't about managing risk in the modern sense. It was about making yourself too embedded in too many power structures to be surgically removed from any one of them. This pattern keeps repeating, and most people never notice. Because today, when institutions tell you to diversify your portfolio, they frame it as mathematics. Reduce volatility. Spread exposure. But the architecture underneath that advice is centuries old, and it was never about protecting you. They have been using this playbook for centuries to protect themselves, weaving their capital into governments, media, infrastructure, and technology simultaneously, so that no single political shift can unwind them entirely. The same move is being made right now. Across industries you use every day, by entities whose names appear on your bank statements. The Machiavellian verdict history proved is this. True diversification was never about wealth preservation. It was about power preservation. The Venetians didn't spread their money to get richer. They spread it so no single enemy could ever make them poor. And the next layer of this strategy is where it stops looking like finance entirely. Number 4. The collapse was engineered from inside. Amsterdam, 1637. The tulip market is imploding in real time. Fortunes built over decades are dissolving in hours. Merchants are weeping in the streets. And the history books will call it mass hysteria, a cautionary tale about irrational exuberance and collective delusion. But here is what the history books never tell you about this moment. Some men in that city are not weeping. They are collecting. The mechanics were never random. Months before the crash, a quiet reallocation had begun among the most connected traders in Amsterdam's financial district. Contracts were being sold. Exposure was being reduced. Not publicly, not loudly, but systematically by the people who had the clearest view of how fragile the structure actually was, because they helped build the fragility into it. The speculative frenzy that consumed the market was not an accident of human psychology. It was an accelerant, and someone held a match. This pattern keeps repeating, and most people never notice. Because engineered collapse follows the same sequence every time. First, create or amplify an asset bubble by making participation feel inevitable. Then, quietly exit before the architecture fails. Then, acquire the wreckage at a fraction of its former value from the people who trusted the system. They have been using this playbook for centuries, from tulips to railroad stocks to mortgage-backed securities. The names change. The mechanism does not. The same move is being made right now. Inside markets you're currently invested in by institutions with information asymmetry, so vast it functions as a different reality entirely. The Machiavellian verdict history proved is this. In every engineered collapse, the disaster is the product. The chaos is the transaction. The crash was never the ending. It was the moment of purchase. And what gets bought in the wreckage, that is where the real architecture of control gets built. That is what we examine next. You have just watched 5 centuries of financial history reveal the same confession over and over. The Medici fell because they forgot to collect. Caesar rose because he made his debt too dangerous to call. Louis XIV was robbed by the men he trusted most. The Venetians didn't diversify to survive markets. They diversified to survive enemies. And every collapse you were ever told was accidental had an architect, an exit, and an acquisition already in motion before the first domino fell. This is not history. This is the operating manual of power, and it has never stopped being used. The pattern doesn't repeat because men are greedy. It repeats because most people never look at the ledger behind the ledger. Now you've seen it. The question is no longer whether this playbook is being run on you. The question is, what are you going to do with that knowledge? If this opened your eyes, the next video will make it impossible to close them again. Subscribe, because the next chapter is where it gets personal.